In the last trading session, we saw the S&P 500 close at the cusp of new all-time highs, being a little over 3% away, which is of course pretty bullish. We pretty much have been seeing stocks just go straight to the moon, or in this case, I guess going straight to Mars. However, we did get a bit of bad news with the Moody's credit rating downgrade on the United States in relation to government debt. Now, the reason why this is kind of bad is because here's the thing. When we have a credit rating decrease, what ends up happening is that foreign investors are less confident in buying our debt. And so what ends up happening is bond prices go down and inversely the yields go up. And so why this is bad for stocks is because when treasury yields go up, it creates this like risk equity premium where you kind of don't want to buy stocks if the yields for buying treasuries is starting to climb up. And so that's not good news. However, we kind of need to talk about why they did this a little bit further, right? The reason why they did this, and this is quoted from an analyst at Moody's, is simply because the federal deficit is just too massive, right? It says, or they said, federal deficit to widen, reaching nearly 9% of GDP by 2035, up from 6.4% in 2024, driven mainly by increased interest payments on debt, rising entitlement spending, and relatively low revenue generation. Ouch, that's kind of bad. And it's also kind of true, right? We've been kicking the can for quite some time, but we also got a bit of other bad news that we recently got in terms of macroeconomic data, which is of course consumer sentiment falling off of a cliff, with nearly 75% of respondents saying that tariffs are likely to drive prices up, and many consumers are believing that inflation is about to make a round two. However, now that we got all the bear porn out of the way, all the bearish news, I kind of want to highlight a bit of positivity, right? Just kind of something to think about. And I want you guys to look at this chart right over here, just highlighting the volatility that we recently saw. I mean, this is just 2025 alone. We're 6 or 5 months in, and we saw that the market hit all-time highs back in February, but then we ended up seeing the market fall down 19%. Is pretty much 1% away from bear territory, but then we ended up seeing stocks rally off of some good economic data, and we're once again positive for the year. So we're not higher than the all-time highs for, back in February, but we're damn near close, and this is with everything going on. Now, I also want to highlight that historically speaking, when we had a credit rating downgrade back in 2011 in August and 2023, it really proved itself to being a buy to dip opportunity. Now, of course, I don't have a crystal ball. I do have a magic 8-ball, right? No, but in all seriousness, I don't have a crystal ball, but this may just very well be another buy to dip opportunity. We're probably going to see some more volatility, and we're probably going to see some pain, but overall, there's still a lot of positive, things that we have to be looking out to. Of course, earnings weren't that bad. Now, of course, we want to see how earnings look going in the next few quarters, right? Because of course, there's still a lot of uncertainty in trade deals. We're having, good negotiations, good talks taking place, but there's still a lot of uncertainty there. But we want to be optimistic, right? And this may actually be just another buy to dip opportunity. Now, one thing I want to highlight is that although the S&P 500 year to date is only up 1.64% at the time of this video, my portfolio is up significantly higher than the S&P 500, right? I started off the year up 30% back in February. Now I'm only up around 15%, so kind of shaved half of it down, but that's still significantly higher than the benchmark. And the reason I share this is because when there's something going on in the market, there's some downturn, there's some volatility, there's always an area of opportunity, right? When something is going down, something else is kind of likely to be going up, right? Whether that's a hedge with gold or maybe defense stocks, or there's always something going up when something's going down. And just a quick plug for those interested in my trade ideas, make sure to check out the links in the description below, because one of the links is going to be a link to join the Push and Profit private group, which, by the way, we have a massive sale going on where you could join for the first 2 months for pretty much 25 cents a day. That's a little over $7 for the month, but think about that, 25 cents per day, which of course the value that I provide with my daily briefings is much higher than just 25 cents a day. I talk about what's going on on every single day the market is open in a private video, and I talk about my trade ideas. So if you want to hear what I'm buying, doesn't mean you have to copy what I do, but if you want to hear what I'm buying or what I'm looking at, make sure to check out the links in the description down below. Moving forward, I want to highlight something in regards to the S&P 500, and that is this area of support, which is around $584.40. Now, with the principles of polarity, previous resistance typically ends up being new support. And I mentioned that the market is just 3% from new all-time highs, but with this kind of bad news, right, this bearish news coming out, we may end up seeing, consolidation, or probably more likely, the market to kind of stifle a bit and kind of come down. But I want to also highlight something else, and that is that from a technical perspective, we saw something pretty interesting take place last Monday, where we saw the S&P 500 gain 3% on Monday, but then finish every day higher for the rest of the week, which we haven't seen any other time in history other than in March 2003, which, yes, is a small sample size, but it's worth kind of noting. Especially because the market was up 16% 6 months later, and then 22% a whole year afterwards as well. Now, I know some of you guys are gonna be like, but Justin, that doesn't matter. And to a certain extent, you're right. But I do think it is important to be aware of historical price action, which, speaking of, I also want to highlight something that is kind of interesting as well, which is this chart showing how the release of Netscape versus ChatGPT continues to kind of track really closely, which is pretty bullish, especially since we're in the beginning stages of this comparison in this bull rally. Now, I mention this because it relates to earnings and the fundamentals, but also just a shift in culture in society. Now, for those of you guys that are a bit younger, you may not know what Netscape was. And for those that don't know, it was essentially one of the earliest internet browsers, right? And of course, we know that the internet changed everything entirely, right? It literally shifted the culture. And I feel that we're in the same type of shift, especially in terms of AI. I've always been one of the people saying, look, AI is not just a fad. It's a real change that's here to stay. And we see that with a lot of companies. In fact, one of the trade ideas that I shared within the Push and Profit private group, I'm not going to publicly say it. I want to keep that trade idea exclusive for those within the Push and Profit private group. But it's a company that you wouldn't think is using AI, but they are. And it's making the company clearly more efficient. And I think that's the overall trend, regardless of this, private trade idea, right? Just think about all the other companies that are starting to implement and embed AI into their practices, and they're able to actually, become more efficient. I think that's going to be the trend going forward. So yeah, things may look kind of bad in the short term. Maybe we consolidate with some of the crazy headlines, some of the crazy news. But overall, from a fundamental perspective, I think AI is going to go ahead and continue to shape us in a positive direction. That's just my opinion. Now, real quick, I just also want to highlight that if you have not done so already, make sure to hit that like button, as it really does help out with the channel. I do a very bad job of trying to remind everyone to hit the like button, but it does significantly impact the channel. It helps boost it in the algorithm, and I appreciate whenever you guys do so. And also, real quick, just leave in the comment section down below, what are your thoughts going forward in the market in the next 6 months? I'm always interested to kind of get like a consensus of what you guys think as well. Regardless if you guys disagree or agree, I'd love to hear what your opinion is. And before you watch this next video, I want to highlight this quote from Paul Tudor Jones that says, "Don't focus on making money, focus on protecting what you have." So regardless what direction we go in the next few weeks, make sure that you are protecting your capital. And if you want to know a great way to never miss an opportunity in the market, make sure to check out this video right over here. And I'll see you guys on that next video. Take care, guys.